Hi, really good to have you back. You might remember that I just recently made a study on gold prices. I studied the volatility during different time periods for intraday traders, and I found using something like 17 years of data and about 13,000 observations that it's the US Europe overlap that provides you the best trading opportunities. Now, in this video, I'm going to give you a couple of momentum strategies that you can use to make the most of my research and of these big moves that the gold market sometimes makes. So let's watch the video and you can see what I mean. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, here I have a gold 10-minute chart, and as you can see, we are focusing on certain time periods here, and these highlighted periods are the Europe-US overlaps, and you can immediately see that this is where the volatility is, instead of these other periods when the markets don't move that much. So if you are day trading gold, if you want to have the proper environment for your momentum trading strategies, then you have to focus on certain times when you're trading gold. And I have done an extensive statistical study on how gold prices move. I will include the video link in the description. And there I have something like 17 years of data, and I looked at the periods when gold is moving the most. As you can see, sometimes these moves are smaller, like $11 or $10, but if you hang around, if you concentrate your trading efforts during these overlap periods, sometimes the full potential is around $26 or sometimes even $38. And we never need to catch all of the move, and most of us will never do that. If we catch some of the move, it's more than enough. So what I've done here, I have taken last 10, at the time of recording this video, last 10 overlap periods. And when I count them, when I total them up and then make an estimation of how much we probably might be able to catch of these moves, that gives us an idea of the potential here. Anything above zero is great. Most traders lose money, so if we can make profit, then it's great. Here I have listed the ranges of the last 10 overlap periods. The ranges are $221 in total. So let's assume we can only catch 20% of this full potential here, because they'll be losing trades and some winning trades, and hopefully we make more with winning trades than we lose with losing trades. So let's use a very conservative number like 20%. So that alone makes about $442 for us per day. And if you're a more experienced trader, then you might make even $1,000 a day. And these calculations here are based on the assumption that you trade one CFD contract in gold. That's basically meaning that you're risking $100 per every $1 move in the underlying, i.e. the gold contract. Obviously, I understand not everybody can trade one full CFD contract and still keep the account risk management conservative enough. If you have a small account, you might trade micro lots or mini lots, and then you obviously have to divide these numbers here accordingly. The two momentum strategies for gold during this overlap period that we're going to take a look at are, first of all, the 10-minute range breakout strategy. And then we're going to take a look at a very different strategy, which is stochastics entry in trend direction. So the breakout strategy focuses on the first 10-minute period when the overlap period starts and tries to catch the volatility that usually follows after the session gets going. So here we have the first 10-minute range. It's been established, and now we're looking for 1 minute close below or above the range, and then we go with the market, and the stop goes beyond this range. So it's obviously, if the range is smaller or bigger, you have to adjust your position size accordingly so that you don't take oversized risks. But to keep this video simple, we're not going to go into position sizing yet. Just think about the position sizing in terms of not risking more than 1% or maximum 2% if you are an experienced trader per trade. And if the range is wide, then you obviously have to make the trade size smaller. Anyway, let's see how the price moves here so that we can get an idea how this works. So first of all, we have market fluctuating below the or close to the low of the range. And finally, do we get a close? Yeah, now we have a close below. It's not very convincing close, but technically it's a close. So that would be a signal to go short. And then the stop level would be above the range high, somewhere here. And now we stay with the trade until we get a move that is twice the range or more, or we get stopped out. So simply either or is okay. And obviously, in a trade like this, or in a trade setup or strategy like this, you want to be looking to reverse your position if the market goes above the range. So if we get a close above the range, we go long, and the stop for the short position is at 20.30.67. Okay, so far everything is looking good for the short, looking very good. But then, oops, now the market really started to move higher. So the entry on the long side would be here, and immediately the short trade would be stopped and the market takes off, and it really does move quite fast. So when you have a big momentum to the upside, you have to think whether you want to really take the profits here, or do you want to see some momentum loss first. And let's take this scale down a bit so that we can see how the market moves. Okay, there's the momentum loss. So you might want to consider exiting here. Alternatively, you can take part of the profits and let the other half run and keep the position on until, for instance, the market closes below the moving average. And here would be the exit. The next strategy we can study is stochastics entry in the trend direction. So for this we use three indicators. We have two moving averages, 10 period on the red here and 50 period on blue. And we want to see a trend developing. We want to see the red moving average, the faster moving average, moving below the slow moving average. And when this setup is in place, we look for failed rallies, and for this we use stochastics indicators, and that sort of helps us to get into trades when the market is likely to move lower again. So the market these signals aren't perfect, but it's a systematic way of doing this. If you find a better way, obviously use it, but this helps the new traders to get into creating systematic strategies for themselves. So here would be the first signal when we have the oscillator around the 50 mark. So the red line here in the stochastics oscillator scale is at 50. So if we have the signal taking place at 50 or above, that's good enough. So the first one would be here when the blue line crosses below the yellow, and then the next one is here. We get quite a few of these signals, so it's up to you whether you want to use all of them, whether you want to scale into your positions or just take one of the signals and then be happy with it. One option is to add 1/5 at a time, so you add 20% of your position here And then when you have the next signal at a lower level, then you add another 20% and so forth, so on and so forth. Obviously, entries into trades, they are only part of the strategy. I'm going to mark them here on the chart as well, so you can see where they appear on the chart. So let me just drag them into the right places. I think the crossover is here, yes. And then the next one is here. Let's make it a little lower. And this one is here. The beauty of this strategy is that you actually get more evidence for your trades as the market, or for your idea really. So if you are correct, then the market moves lower after your trades, and then that's basically the evidence that the market flow is on your side. But like I said, entries are only the first part of the strategy. We need to have exits. We need to consider where we take the loss. And here I think the kind of logical level to play stops is maybe 2 times this recent volatility, or somewhere above the blue, the slow moving average. And then obviously you would have the stops for all of these different entries at different levels. And if there is a big difference between the entry price, like the candle closes here, that this difference between this entry price and the stop price is bigger, you have to adjust the position size. And then the question of when to exit the trade, it's probably wise to stay with the trend as long as it lasts. When you see the momentum loss and maybe the market closing above the moving average, that might be the time when you want to consider moving or closing out of these trades. Thank you for watching, guys. Now that you know what time of day is the best time to trade gold, and you know a couple of momentum strategies that you can either use as they are or maybe adjust and tweak them to your own liking, that I'm sure that now you can go and start really taking advantage of these moves. Maybe it doesn't happen the first day or the next week or in the first month. Just be gracious to yourself. Give yourself time to learn. Just keep your risk-taking conservative until you know that you know what you're doing. And this other video where I talked about the study I made, I'll include the link in the description so you can access it there. Until the next time, trade safe and see you soon.